Silicon Valley Bank's 48-hour collapse led to the second-largest failure of a financial institution in U.S. history. SVB was one of America's 20 largest commercial banks and is now under the control of the U.S. Federal Deposit Insurance Corporation after it became unable to pay back customers who withdrew their deposits. Though experts quelled fears of a wider contagion, the bank's collapse could have significant ramifications on the startup and tech sectors. Founded in 1983, Silicon Valley Bank provided financing for almost half of U.S. venture-backed technology and healthcare companies. They have been hurt by higher interest rates and dwindling venture capital. While relatively unknown outside of Silicon Valley, SVB was among the top 20 American commercial banks, with $209 billion in total assets at the end of last year, according to the FDIC. Its stunning, and seemingly rapid, fall is the largest shutdown of a U.S. bank since Washington Mutual in 2008. The wheels began to come off Wednesday, when SVB announced it had sold a bunch of securities at a loss, and it would sell $2.25 billion in new shares to shore up its balance sheet. California regulators closed down the tech lender Friday. The FDIC is acting as a receiver, which typically means it will liquidate the bank's assets to pay back its customers, including depositors and creditors. The FDIC, an independent government agency that insures bank deposits and oversees financial institutions, said all insured depositors will have full access to their insured deposits by no later than Monday morning. It said it would pay uninsured depositors an advance dividend within the next week. The FDIC took over in the mid-morning Friday. Usually it waits until markets close. SVB's condition deteriorated so quickly that it couldn't last just 5 more hours, wrote Better Markets CEO Dennis M. Kelleher. That's because its depositors were withdrawing their money so fast that the bank was insolvent, and an intraday closure was unavoidable due to a classic bank run.